So we start with, the relative valuation. Okay, fine. So we have calculated, various multiples. Fine. Like, so I'll just show you, what we have done so far. It's a very easy technique as compared to the DCF technique. Just hold on for a while. Let me just start. So, there are various kinds of multiples which we use to value a company. One is called the earning multiples. Okay. I mean, if we broadly look into the multiples, earning multiples, book value multiples, revenue multiples, price to sales. Okay. Price to earning is a earning multiple, sector specific multiples. Okay. Fine. So, so what we have done so far, and you have calculated your this thing on price to earning ratio, enterprise value to EBITDA, or maybe some you use whatever enterprise value to EBIT. So these are the multiples which are earning multiples, where we take the market price of the share and divide by the numerator is the price and the denominator is earning. Okay, whether we take earning for the shareholders, whether we take earning for all the stakeholders, or EBITDA, which is a proxy to cash, okay, or the operating profit of the company. But remember that the both the multiples should be consistent. Fine. That means the numerator and denominator should track the same kind of stakeholders. Like price to earning, price is for the shareholder's price or the market cap, divided by net profit which belongs to the shareholders. So net profit belongs to the shareholders, and the shareholders, the price of the share is also the shareholders' price. Okay, so the multiple is quite consistent. Okay, now it can be a book value multiples like price to book value. Okay, enterprise to book value. Normally we don't use these variables for valuing the company, but for certain companies like banks and all, this is quite relevant. And we want to, if you want to look as the market as a whole is undervalued or overvalued, we always look at the price to book ratios and other things. Okay, I'll give you time. Okay, don't worry. So then we have price to revenue multiples, like price to sales. Now this is a multiple which is not consistent. The price is the share price, and the sales is basically sales which has been used from all the resources of the company, whether contributed by the equity shareholders or by the company which has taken debt. So this is not consistent, so much consistent ratio compared to the normal. So the price to sales ratio, enterprise value to sales ratio. Now enterprise value to sales ratio is more consistent compared to price to sales ratio. We take the enterprise value, okay, value of to all the value of the company divided by sales. Okay, so this is more consistent compared to price to sales ratio. If you have any questions, have you followed why enterprise value to sales is more consistent compared to price to sales? Have you understood this? If you're not understood, if you're not understood, just raise your hand. Okay, fine. So price to sales, what we take in the numerator, the share price. Okay, divide by sales. Okay, now sales of the company is derived from using all the resources of the company, whether it has been contributed by equity shareholders or by the loans which company has taken or the borrowings. So we are trying to calculate a ratio based numerator which belongs to the shareholder, but the denominator belongs to everyone. So this is inconsistent. Whereas when you take the enterprise value, which is the market value of the shares of the company, market cap plus the loans, okay, minus cash. So if you take that and divide by sales, then we are having, we are comparing apple to apple, isn't it? We are saying the sales have been generated out of all the funds being given by all the stakeholders. But here, in the first ratio, we are saying the sales which is generated from all the contributions from everyone, but we are trying to compare it. We are trying to find a valuation ratio based only from the market cap or the price of the company. So that's why it is inconsistent. Have you followed now? Okay. If you haven't, just go through my video again and try to do your own research. You will be able to follow it. Okay. Fine. Then we have sector specific multiples like EV per ton, enterprise value per ton. Okay. Now, for example, Tata Steel, which is trading, for example, say enterprise value, we can calculate the enterprise value and calculate the tonnage, that how much steel it produces. Okay. Suppose it is trading at say 10,000 rupees per ton, whereas another JSW Steel is another steel company which is trading at 12,000 per ton. So we say JSW is more expensive compared to Tata Steel. Fine. If Tata Steel has more progress to make and a higher growth rate, then we will going to invest only in Tata Steel and not JSW Steel, because we'll say JSW Steel is expensive. Okay, fine. So per steel, this was more, when I heard this first in my life when I was working in, Idea Cellular. So where all the deals were happening per subscriber. Okay, per subscriber, EV per subscriber. Okay, like even the WhatsApp, which was bought by Facebook, it was, like they paid about, $65 per subscriber to WhatsApp to acquire the company. Okay, so then we try to find out, which company is costlier, which company is cheaper, based on per subscriber basis. Like Idea Cellular, if it's trading at, say, for example, 1,000 rupees per subscriber, or maybe 1 lakh rupees per subscriber, whereas Bharti is trading at, say, 2 lakh rupees per subscriber. We say Bharti is expensive. Now it doesn't mean that we should not buy Bharti, but we should buy Idea. It all depends on future prospects of the company. Fine, but it will tell you, at what price it is, whether it is overpriced, underpriced, or rightly priced. Okay. So EV per employee, for example, all, IT companies, all, like banking companies, for example, there, the employees are the main source of, doing business. The human capital is the most, I mean, they use. Okay, apart from, the equipments and other things, I mean, the computers or the IT technology. So EV per employee is relevant for those companies. For example, an accounting firm, for example. So EV per employee will be like KPMG or other companies. Okay, PricewaterhouseCoopers. So these companies will be, doing their valuation based on, and then we find that which companies, it looks cheaper or costlier. Okay. So so now, we'll just go to basically. Okay. So these are the multiples which we have, seen so far. The PE ratio, price to book value, EV to EBITDA, EV to capital, EV to sales. So these are some of the ratios. Okay. Now finding the right firms to use for comparison and controlling for differences. What it means, first of all, if you have to compare the firms, then, we have to compare the similar firms. Like you have done your project based on industry specific. Some companies have chosen, students have chosen banking, some students have chosen telecom, steel, cement, all those you have chosen. Okay. Now, for example, if you choose, automobile, for example, so you'll find the list, Maruti, you will find Tata Motors. Okay, those companies which are listed on the stock exchange. Some of the companies are not. So we'll find the listed companies. Okay. So now Maruti and Tata Motors, they look to be in the same industry. But if you look at, their profile, what they are doing basically, it's quite different. Okay. Because, Maruti is into a passenger car segment. Whereas, Tata Motors is both in passenger as well as commercial vehicles, isn't it? So they seem to be in the same industry. When we can say they can be compared, but when we go deeper, we find both are in different sectors and both have different, clientele. Okay, and both may have, different kind of, businesses to some extent. Okay, and may differ. So the comparison, is not complete. So then we control for those differences. If such thing is there, then we try to control for the differences. For example, let's take a real estate example. That one house which is the same locality, same area, it's selling for, say, 2 crores. Another house in the same locality, and just very near to it, is selling at 3 crores or 2.5 crores. The difference can be that, the second house is very near to the, sea, or very near to, sea beach or golf course, or vastu wise it is much better compared to the other one. Okay, so the company which has a, I mean, the property which has more in an advantageous situation will always trade at a higher value compared to the other one. Both are similar size, same houses, but it may differ. Okay, we may say that they should have similar prices, but the prices can differ because of different characteristics attributable to those two houses. Similarly, for companies, there can be a differences. Okay, so we have to control for that. If you control for that and then bring everything at par, then we can just compare it. So if there is any mechanism by which we can bring them at par, and then we can just compare them, and then that comparison would become valid. But it is very easy to say, but very difficult to do. Okay, let's understand. Okay, multiples are used in conjunction with comparable firms to determine the value of a firm or its equity. So either we use the firm multiples or we use equity multiples. Okay, fine. Firms within the same industry or business. So what is a comparable firm? First of all, definition. Firms with the same industry or business. So normally we look for that. Okay. Firms with similar cash flows, growth, potential, and risk. Now, another way of looking out instead of looking at industry is that we look at the companies which are similar in terms of cash flows, in growth prospects, as well as in risk profile. Okay, if the companies are suppose there are two companies, both are growing at the same pace. The future growth is going to be say 20-25%. Okay, and both are equally in terms of risk. For example, we take either a standard deviation to measure the risk or beta. So both are having similar risk, similar volatility. So we say that that is the ideal way of finding the two companies or comparing the two companies rather than just basing ourselves only on industry. Okay, a telecom firm can be compared to a software firm if two are identical in terms of cash flows, growth, and risk. Fine. So we look at basically, the most important ones are, the cash flows, growth, and risk. And growth and risk are easily, I mean, we can always compare. Okay. We can. We'll do that today only. Okay. Yeah, there's a question coming. What is the question? इनको माइक दे दो. हाँ दे दो कोई बात नहीं मुझे आ रही है. I could hear the noise here. Okay. हाँ हाँ आ रही है बिल्कुल. You can carry on. Yeah. No, no, no. Just hold on. That is, first of all, we are trying to find out based on like EV per ton. We found Tata Steel, we found JSW. Now, after that, our decision whether we should invest or not in a company which is trading at a EV per ton cheaper. For example, maybe Tata Steel is trading at a cheaper EV per ton. The next thing is we look at the growth and the risk basically, and then we make those adjustments to our thinking, and then we decide should we go ahead or not. Ah. So just hold on. These are very good, valid questions. I'm not denying that. I'll be covering most of the things, so you can ask me if your still question is not answered. But definitely, mergers and acquisitions, companies who are growing, growing for, I mean, increasing their, expanding their footprint. Okay. So, the whole thing is that if the companies are, has a good track record, they are trading at a fairly good value, and they have good future plans to diversify and expand. So all that decisions are taken to evaluate whether we should be buying that company or not. It's not just looking at the multiple and we decided, okay? It's not like that, okay? So after, multiple just gives you an idea. After that, it's your own research with regard to the future growth potential of the company. What kind of, what is the track record of the company? How far how the company has grown, and how the company is going to grow in future. Whether it's going to, buy more companies in stride, or maybe it's going to expand organically or inorganically. So you have to look at the, like suppose, I told you that if you look at the management discussion and analysis report, so they give you about, what is the future course, how the company is going to expand. So it will give you a fair idea about that. So close down your mic for the while, and then, okay, ये mic इनको दे दो. So reserve your questions at the end now. Can you read this? Controlling for differences. So hold on. So first is we are looking how do we control for differences. We know that the two companies may be in the same industries like Tata Motors or Maruti, but they are not similar because they have different kind of business products. Okay. So how do we control for that? Okay. Let's look at. Now, basically, relative valuation approach is used to value a company. Okay, so it says in the first that you will end up the firms that are different from the firm what you are valuing. Now, suppose there's a company. Okay, you want to value it. It's an unlisted company. Okay, there's a company which is not listed in the stock exchange, and you want to value the company. The first task will be to look for the companies which are listed in the stock exchange, which are similar to the company which is where you want to, which the company you want to value. Okay, and then try to see at what multiples they are trading, and after controlling for differences, you arrive at a multiple which you apply to the target company. Okay, for example, when I told you that I was working for a company called Hero Motor Group. So there's a company which was we wanted to sell that company. Okay, or there was another company like Western Union Bank. They wanted to buy some stake in our company or wanted to buy that company from us. So the company which we wanted to actually sell was not listed in the stock exchange. So they couldn't locate any company in India which was doing similar business. So they went abroad and saw a company in Argentina which was doing almost similar business to what we were doing in India. So they found that that company was trading at a certain multiple, for example, 15 or 12 or something. Okay. So they said you can apply that multiple to the financials of your company to arrive at the value of your company. Okay. Fine. So that is what is written that, this technique is more used for valuing, can be used for valuing any company which is not listed on the stock exchange. Or second, you can even value the company based on whether the company is overvalued or undervalued for investing purposes also. The companies which are listed in the stock exchange, you want to know whether you can still buy or sell those companies. Okay. Read further. Okay, so there are three ways. First is subjective adjustments. Okay. Second is modified multiples. You can modify a multiple. Okay. A third one is a regression technique. Okay. Let's understand one by one. Subjective adjustments. Okay, so we have done that. In your exercise, what you have done, you have calculated the average, the median multiple of all the firms on various, valuation multiples. Okay. Now you find that that the average P multiple is 15 in the comparable firms you have, but one company is trading at 22. So if the companies have identical features, there is it can be compared. They are all growing at the same pace, or the future growth has to be same. Then we can say that the company is overvalued, isn't it? The average is 15, so all the companies which are above average, they are overvalued. If all companies are similar, there are no differences altogether. Okay, but when we find that the companies differ, that one company, for example, in an IT pack, for example, TCS, okay, about a few years back, it was growing at a good pace. So it was going at say 25% rate of growth. And TCS was commanding a higher PE ratio compared to the average PE ratio of all other companies like Infosys or HCL. So TCS higher P multiple was justified because of it has a, greater growth story ahead, and all the companies are having similar kind of risk. Like if you look at the betas, they are all trading at say 0.75 or thereabout. Okay, so when we say the risk is same, only the difference is the growth. If TCS or any company in particular industry or has a great potential or the future prospects of the company are good, their historical past is good, and the analyst saying that their company is going to grow, fine, at say 20% or 15% or 30%, that company will command always a higher P multiple. And we can't say that it is overpriced when we look at the average. Is that okay? Okay. Now, this is what we did. Okay, fine. So, like, look at the TCS here. TCS is trading at a higher P multiple, okay, but the it's not given what is the growth and other things. The multiples are given, so it's trading at a P multiple of 25. But if you look at the median multiple, it's about 16.7. So it's trading at a higher P multiple. So at that particular time, when I noticed the TCS was trading at a higher P multiple because the company has a great growth story ahead in this era. When I prepared this slide, okay. So, yeah, read further. Subjective judgments, yeah, further. Have you got this? Here, then, if the companies are similar, they have similar growth, similar risk, then we just look at the company which is having a lower P multiple compared to the median. We say that this is the company we should be putting our money. Okay, all the companies are trading at a similar, different P ratios, but some at higher, some at lower. But when we compare it with the baseline, which is an average, so the companies which are trading higher than the average, they are all overvalued. The companies which are trading below the average, we're saying they are undervalued, and we should, go and buy those companies because all the companies have similar growth and risk and cash flows in future. So the second technique, which is this was the subjective. So we understood first one. Second one, how do we modify the multiples? Right? So this is very important. There are couple of things: growth, risk. So we look at first the growth, and growth. How can we see how the EPS is growing? Suppose this year the EPS is say 100, next year it's going to be 120. So we say there's a 20% growth next year. Okay. So here we take the P ratio and divide by growth and calculate the PEG ratio, which we have all done. Okay. Now, if we have calculated the PEG ratio of all the companies, so you have actually neutralized the growth. Okay. Only the risk remains. Suppose all the companies are having a similar risk. Now we can compare the companies, okay, on the PEG ratio. On the basis of PEG ratio, we can say which company is overvalued and which company is undervalued because growth has been sidelined. Because we think that, we have already, divided by P ratio by growth and calculating a new multiple, okay, where the growth has been factored in for all the companies. Now, the other two things remains the cash flows and the risk, this thing, okay. Assuming that risk and other, factors, other variables are similar, then we can just find out, which company is better, which company is not better, where to invest, okay. Okay. Great. Other than one being controlled for. So we are saying all other variables are similar, risk and other things. Okay. Only the growth was a differing factor. So we control the growth. Okay. We divided by the P ratio by growth and got a new multiple. Okay. And now we are comparing that multiple and finding which companies are the companies which are having, suppose the average PEG ratio of all the companies you have. Research. So the average PEG ratio is say 2, for example. So any company which is trading below 2, you can say this company is okay, but all the companies above 2 are overvalued, isn't it? Though, of course, PEG ratio, the definition of PEG ratio is anything above 1 is expensive, anything below 1 is cheaper. But when you find all the companies are trading because markets are always either optimistic or pessimistic. So you may not find companies trading below 1. So then what is left? You still want to buy. Okay. So then you look at the average PEG ratio. Fine. Fine. So now if average PEG ratio is 4 or 5, then we say all the companies are, trading at a very lofty valuations. So you'll wait for the market to correct before you start putting your money. Fine. Because all companies are trading at a very, very high PEG ratios. But if the PEG ratio is around 1.5 or so, average one, then, instead of waiting, you can just buy it because, ho sakta hai, the market may, go up by another 30-40%. It will not give you a chance to enter into the market or buy that share. So first you have to look at, what is the threshold level of PEG ratio which is going to be idle for you, where you can, still invest. It looks to be, it suppose it's 1.5. 1.5 by definition, theoretical definition is expensive, but average is 1.5 of all the 10 companies in your list. So what to do? Either not to invest at all, okay, or if you want to still think that the market, overall market outlook of the India and the market outlook is very good, the companies are going to, and these are the industry which is going to the best, so you'll be missing the bus. Okay, so you choose those companies which are below the average. Suppose the average is 1.5, you say, okay, if it is 1.3, 1.4, I'm going to invest because it is, the whole of the market is 1.5, I'm investing at 1.3. You can justify your investments like that. Is that okay? Have you got it? Now, the P ratio, read the top line. Now, what happens is that, if you look at example in India, because India, on a particular industry, you may not find more than 3, 4, 5, 6 at the most. Of course, it's expanding, and now we are finding more and more companies are coming in the peer group. Okay, when you look at in US and other countries, there are so many companies there, okay, which are listed. Now look at, this is the list of all the companies which are into beverage. Now beverage can be, either alcoholic or non-alcoholic. Fine, beer, Coke, Pepsi, wine, all kinds of other alcoholic beverages. So look at, these companies, for example, Andre Wines, okay, Bush, Boston Beer, Brown Forman. So these are the companies, Coca-Cola, and then the list goes on. So these are all companies in the same similar kind of industry. Now some numbers are given. The first one is trailing P ratio. Okay, so we always look at the trailing P ratio, the last 12 months, which is more important. Then expected growth. The analysts have estimated an expected growth of each of the company. The standard deviation, okay, again, which is a risk parameter. Either you can take a standard deviation or a beta, whatever is available. Okay, have you got standard deviation for most of the companies which are this thing? आपके project में? Okay, good. Then we calculate the PEG ratio by taking the trailing PE ratio divided by the growth. Okay, fine. So you have calculated for everything. Okay, now just go at the bottom. We have calculated the average. Now tell me the average. What is the average trailing P ratio of 22.66? Okay, and what is the estimated growth of all the companies? 12.6. What is the standard deviation? 33. And what is the PEG ratio? 2. So now all stages all set for you. So you now first look at the PEG ratio is 2, and remember two numbers. Standard deviation is 33. Okay, and PEG is 2. Is that okay? Fine. Now, because the growth has been controlled, okay, it's only the risk which has to be looked. So look at the first company, Andre Wines. Fine. Now tell me one thing. What is the observation regarding Andre Wines? Is it expensive or is it this thing? Ek second. I'm asking one by one. Okay. Yeah. Undervalued. Okay. Just hold on. आनंद एक ये बोलो. नहीं पेन नहीं, यहाँ यहाँ पर लिखो नाम इनके और इनके अभी देखते हैं. ठीक है. It's undervalued. Okay. And why you're saying marker दो पीछे से. I told you to capture two numbers, okay? Have you? Okay. The first one is, I'll give you another chance. The standard deviation and the PEG. Look at the average numbers here, okay? Please don't assist. If you speak anything, your numbers will be cut. Okay. Okay.
Overvalued, sir.
Overvalued. Okay. And so that's all. Anything you want to say further? Bus. Overvalued है. Why it is overvalued?
So because its industry P ratio is average P ratio of industry is 2.5, 2.33.
हाँ.
नहीं सर, वो इंडस्ट्री का अप्रोच 2.2 था. सर,
हाँ, इंडस्ट्री का एवरेज लिख दो ये.
वो थोड़ा
जस्ट होल्ड ऑन. हाँ,
नंबर सर.
हाँ, नीचे लिख दो.
2 है सर.
2 है और स्टैंडर्ड डिविएशन जो है 33 पॉइंट. ओके, सो ही सेज, इनका नाम लिखो पहले, चिराग. ये कहता है ओवर वैल्यूड है. ओके, हाँ, अंडर वैल्यूड ये बताया, ओवर वैल्यूड है. एंड रीजन ही सेज दैट द पैग रेशियो इज, पैग रेशियो 2 है. ओके, इसको दे दो आप 6 नंबर 10 में से. अब तुम एक जगह में रह गए 6. ओके, होल्ड ऑन. ओके, नाउ व्हाट्स योर नेम? शमा. शमा का देखो. शमा, आप बताओ इसके बारे में बताओ आप. नो, कॉर्बी का बताओ. कॉर्बी, Corby is overvalued, undervalued? Corby is undervalued or overvalued? 1, 2, 3, 4. Huh? Undervalued? Undervalued. लिखो undervalued शमा. नहीं, नाम लिखो ना शमा में. हाँ. Undervalued बताया इसने. Okay. इसको दो 0 नंबर. Okay, why is undervalued? Tell me. What is the average? Khatam. Okay. Next. Okay. Now let's talk about Hansen natural this thing. आपका क्या नाम है? यशवंत. यशवंत. हाँ, बताइए. For which company? For Hansen natural. 0.5. This will not be considered for your grades. Don't worry.
Undervalued because
Risk is ज़्यादा.
because it's the risky, but the PEG ratio is likely, so it's most probably going to give us a good return because of the less PEG ratio in the near future. But however, if the client has a risk aptitude, then only he should consider this company. Otherwise, he should drop.
नहीं, अगर risk aptitude है,
Then only.
अच्छा, मतलब he can bear higher risk.
If he has a
But
risk
it is trading at 0.57.
Yeah, that's why, na, because the company has a higher risk, so the chances are in future there is a good growth prospectus. Therefore, the PEG ratio is currently low right now.
Okay, so you're saying that the company is undervalued,
Yeah.
but because it's having a higher risk, so the people or investors who have a
High
aptitude
risk.
for a higher risk,
Yeah.
they should invest. Give him 10 out of 10 marks and sit down back. क्या नाम है इसका? यशवंत. ठीक है, तुम्हारे तो क्लास पार्टिसिपेंट 10 में से 10 होंगे. ठीक है, बाकियों के अभी ऑन होल्ड हैं. बाकी तो मैं डिसाइड करूंगा. आई एम नॉट गिविंग टू okay. Okay, so actually, this was the best way of assessing it. Look at both the PEG ratio as well as the risk. Now this company, Hansen Natural, a very high risk, 62 compared to a average of 33. Okay, so it's very risky. Though because it's very risky, it's trading at a low P multiple. That's a reason, a low PEG multiple. Okay, so the PEG ratio is, the trailing P ratio is also 9.7, and the PEG ratio comes to be only 0.7. Okay, fine. Is that okay? Okay. Now we come with sector regressions. So third technique. Okay. Read further. Okay, hold on, please. Hold on, please. Now listen. Yeah. Now, if just, it's not just the growth in EPS. There are other factors also which can affect the P ratio, like the risk, at what, percentage, the bottom line, top line, everything, what are the futures with respect to, ultimately, the top line, bottom line growth reflects into the bottom line. Basically, we look at the EPS growth. Okay, fine. So, then the best way is to find what should be the predicted PE. Okay, if the P ratio of the company is 15 and the predicted P ratio comes to 12, then we say it's overvalued. Okay. So how do we calculate the predicted P ratio? Okay, by looking at the regression technique. So that is the question. Okay, so we'll answer that. Okay. So this technique, please hold on. Please, this technique is works only when you have large number of firms. Okay, because we are using regression technique. Okay, so we should have at least many companies in your list. Then only it will give you a very good this thing. Okay, just hold on. Please listen first of all before asking. Just listen and I can answer. Please ask. Okay.
We have studied regression in our first semester. In regression, we find the
Fine. Okay, just hold on. What's your name?
okay, question.
पंकज प्लीज अभी अभी आप रिग्रेशन जो पढ़ा है आपने अभी अपने पास रखो मैं आपसे कहानी सुनूंगा बाद में थोड़ी देर में आई एम नॉट गोइंग इनटू व्हाट यू हैव स्टडीड ओके बट इट्स अ रेलिवेंट थिंग आई एम नॉट सेइंग बट अभी उसके साथ आप डायगर्स मत करो हमारे टॉपिक को अभी हम चलते हैं उस पर अभी आएंगे आपके क्वेश्चन में ओके सो जस्ट कीप योर क्वेश्चन आउट ऑफ योर माइंड एट द मोमेंट आई विल आंसर योर क्वेश्चन डोंट वरी okay now this approach works reasonably well when the number of comparable firms is large and relationship between multiples and variable is stable so this is very important that it's not that the regression technique can give you everything. Fine. First of all, it should be large numbers and the relation should be stable. Okay? Fine. Relationship should be stable. Now, what is that? So we'll answer that. What is stable? Okay. Okay. So your questions are all valid. I'm saying just hold on for a time being. Okay. I'll answer your questions. Okay. So let's now go to the regression technique. Okay, now regression technique is basically what is that and how do we use that? So we're going to talk about. So these are all the same companies, okay, which was put on the board. So there are about 16 companies, okay, and the average is given here. Fine. The averages when I calculated slightly differed from the averages which is given in the slide because that was from the Ashwadhamodaran's this thing. So maybe there's slight difference, not much. Okay. So we have, the PE ratio of each firm which is given, the trailing PE ratio. Is that? Okay. So this is our Y variable. Okay. And then we have to calculate the X variable, the dependent and independent variable. Okay. So the X are all, variables on which the P ratio will depend upon. Okay. Fine. So EPS growth and standard deviation, two are given to you for all the companies. Okay. The EPS growth and the growth and the risk. Fine. The growth and the risk has been captured, which are X variable and Y variable is the PE ratio. So we want to know what should be the PE ratio based on the growth and the. So I'm just I'll do that. हाँ zoom कर रहा हूँ. Okay. So look at this. Okay. Look at this table. For example, regression techniques, how it is used. You have studied all regression. अभी अभी semester में पढ़ा है? अभी एकदम. So anyway, so I'm not going to discuss, what is the regression technique. Okay. So I'm just going to use that straight away. Okay. Fine. Just to give an idea, what I always, find that example to understand that what technique is. Suppose there is a, full stadium like Narendra Modi Stadium. How many people can come in the stadium? 1,15,000 or 20,000 people can sit. Okay. Now, there are people who have put their stalls. They're, selling coffee, tea, samosas, and all that snacks. So they expect, the stadium to be full, or they can expect the stadium to be half full, depending on what kind of match it is. Okay. And they want to plan, how much, tea they should, how much milk they should order, how many tea will be sold, how many samosas will be sold, how many, other snacks will be sold. And suppose, Gujarat, it's a winter month, for example, and it's quite cold. Suppose it doesn't have become very cold, but suppose it becomes cold. So the sale of coffee, tea will very good. People will buy samosas. So it will depend upon, the temperature of that time, what is the temperature. So we can look at various variables and plug those variables and we'll get how much, if the stadium is say half full, how much you should be ready to what will be sale of all the snacks and tea or coffee. So you can work out that. Okay, fine. So this is basically the regression techniques, some examples which can be used in practical purposes. Whether people are using it or not, I don't know. Okay. So now, first of all, I'll just show you the output and tell you how it has been calculated. Now here, Anderwine's P ratio is how much? 8.96. Okay. PEG ratio is 2.56. So this we have done already. Okay. So I have not prepared the output. Okay. I thought I was sharing the output, but it's what we have already done, which we have seen. Okay. Then we look at the PEG ratio and the standard deviation, and we did our assessments. Okay. Now what we are going to do is we are going to go to data. Okay. Just have a look first, and then you can do it yourself later on. Look at the data, and there is some tab here, data analysis here. Have you used that?
Yes, sir.
Something use kara?
Yes, sir.
Very good. Wonderful. Okay. Now you are going to do is that you are going to invoke the data analysis. Okay. Okay. And go to इसमें डेटा एनालिसिस में आपने क्या क्या रिग्रेशन ही देखा है और भी चीजें देखी? हाँ, अच्छा. Okay. So then we have regression here. Okay. And then we choose this. Okay. As X multiple. Y. This is Y range and this is Y range. Okay. This is Y. Okay. So we can use all here. Okay. Fine. And then we go to the X range and choose, the both one, the growth and the standard deviation. Okay. And then we can, we can have residuals, standard. Okay. So इसको normal probability plot कुछ भी कर दो आप. Okay. And say okay. So you will have this chart. ये बनाया हुआ आपने? Okay. Then at the bottom we have this predicted value. Okay. So we just copy this. Okay. Copy this and paste here. So this is the predicted P ratio which we have got. And say this as predicted PE ratio. Fine. And then we can, make it up to 2 decimal places. Okay. Fine. ये आ गया? Fine. Now tell me, now, what's your name? Ashutosh. Now tell me the first company, Andre Wines. So what do you have to say about the Andre Wines? When you calculate the predicted P ratio, so would you like to put your money in this company, Andre Wines, and why? And why not? क्या नाम बताया आपने? आशुतोष. हाँ हाँ लिखो. So I'll pick up 3, okay, people. So Ashvi later on, and then so first of all I'll just hear you out, okay. आप क्या बोलते हो? ये company, should we invest in this company? Andre Wines. We should invest. Okay, hold on. ठीक है. What about you, Ashvi? The first company, should we invest or not? Yes or no? What do you say? Yes or no? So नहीं, maybe can be the right answer. It's not. I mean, हाँ. No, based on the predicted P ratio. I am saying we have another thing which we have just calculated. Okay, so base your decision on the predicted P ratio. Should we invest or not? Yes. Okay. So everybody gets. Now, what is your answer? Anand? He says we should not invest. And why should not we invest? Tell Anand.
So because of average compressor P.
नहीं, look at this.
So
All zero,
सर मैं
including
बताऊंगा
Anand.
सर
हाँ
वो
नहीं
इंक्रीज
आप
करना है
बताओ.
सर इंक्रीज करना है इसलिए इन्वेस्ट करेंगे सर पी रेशियो ग्रोथ की कगार पे है सर वी
जब
विल
पीई रेशियो
इन्वेस्ट
प्रेडिक्टेड है ना, जब
हाँ.
प्रेडिक्टेड है तो अगर आप प्रेजेंट में लाएंगे तो अभी तो प्रेडिक्टेड है हमारा
सर
पैसा
बढ़ेगा
बढ़ेगा
ही
ना।
ना
No,
सर
no, it's not it's not sorry. The question is it's not predicted. It's predicted calculate करा उसने. This should be the P ratio which the share should be trading at, but it is trading at what? 8.96. ये 8.96 पे ट्रेड हो रही है और ये ट्रेड होनी चाहिए कितने पे? 10.3 पे. So should we not? Answer should be what? Yes or no? मैं पूछ रहा हूँ. Because what happens is that look at Boston Bear, it's trading at 20. It should be predicted P ratio is 26. We have calculated a predicted P ratio that should be trading at this ratio, but it is trading at only 17. So we should be buying it, isn't it? So अगर ये higher है, for example, if it is 10, look at a company which is having look at a company which is having a higher standard deviation.
बॉस्टन भी है, बॉस्टन भी है,
हैंसन सर
बॉस्टन भी है।
सर हैंसन 62 है
Okay, look at this white man. Okay, the P ratio is 25, but the predicted ratio should be 13. Okay, and here the standard deviation is so. Yeah. Now let's understand. Let's understand. Just hold on. Let's look at the EPS growth. Look at the EPS growth. For example, company. This company, Boston Beer, is having a 17.33 growth prospect, but in terms of standard deviation is higher. So it says that the correct P ratio or the predicted P ratio should be 26.77, whereas it's trading at 10.59. So that we should go ahead and buy it. Invest. Okay. Now look at a company which is trading at 7.55 P ratio. Okay. Fine. So this also it's saying go ahead and buy. Its growth is 7.5. It's not the growth is not there. Growth is there, and standard deviation is far less. Okay. Look at where the growth is very less. Growth is, suppose the growth is only 3%. Okay. Now find what it's saying, that it is risky also 25, but below the average risk, but the growth is the least. Okay. So it says that the P ratio predicted is 8.82. So that means currently it seems to be overvalued, isn't it? So if we have to just understand and apply the thing to this and find out our assessment. Okay. Fine. Are you with it? Have you got it? So आप एक और देखते हैं, सपोज एक सेकेंड एक और देखते हैं बिफोर वी गो. कोको कोला which is trading at 44, it says that it should be trading at only 32. The growth is 19, but overvalued है. Okay. Look at another, for example, Molson. It is trading at 43. The growth is there. Okay. And it should be 34. Okay. Now look at the consistency. Okay. एक चीज और देखते हैं. This is 2.5 and this is 10. Okay. So 2.5 says expenses. So both are giving inconsistent result, isn't it? PEG ratio, which is just based on the growth, and predicted is based on growth and risk both. Okay. So we can just compare and find out, where we are getting, kind of, similar results. But we can't compare the PEG ratio with the predicted P ratio. Predicted P ratio is based on both the growth as well as the risk of the company. Whereas in the PEG, the risk is missing, isn't it? So is that clear to you? Okay. So I just close. A company that trades at a P ratio lower than the predicted P from the market regression is undervalued. Just please listen to it. A company that trades at a P ratio lower than the predicted P from the market regression is undervalued. Okay? And if it is trading at a company trades at a P ratio higher than the predicted P ratio, then we say it is overvalued. I think this is what we did. Up now, look at this company. Look at this company's predicted P versus the actual P ratio regression technique. Okay. which we just used it, APT Satellite Holdings, ADR. The P ratio is 31. Predicted P ratio is 39.27. So that means it is undervalued to the extent of 21%. This is what we did in the class. This is what interpretation we have seen, or it was different one. यही जहाँ I thought I just done the opposite. हाँ तो आप ये देखो कि यहाँ पर हमने क्या करा है. These are the P ratios and these are the predicted P ratios calculated through regression technique, and then we assess ourselves whether the company is undervalued or overvalued. So here, like 38%, the company like Gillette Communications. These are all telecom companies, okay, which is trading at a P multiple of 22, whereas it should be trading at 36.84, which means that it is undervalued by 38%. Is that okay? And all those which are in positive, they are overvalued, which means the predicted P ratio is 18.66, whereas it is trading at 19.60. Asia Satellite Telecom Holdings. Okay, fine.